Hi guys, good afternoon. My name is Dominic. Thank you, Doug, for the introduction. Thanks for being here today. We're gonna keep this light, keep it fun. So thanks for everyone who's tuning in here from the partnership with Firstmark and TCG. So first thing I wanted to touch on today for you guys is going to be this is my contact information. So today throughout our presentation, if you have any questions, if you're like me, once you do these things hours later or the next day, you're going to have some questions. So go ahead and take a photo of this with your phone if you'd like. Also, that's a QR code right there that'll scan that goes directly to my calendar. So if you ever wanted to have a session with us, a one-on-one, we can meet, after school during your conference period. Obviously, with the holidays coming up right now is a great time to get some questions answered. So there's all my information there. So a little bit about TCG. So we actually are the investment arm of Firstmark Credit Union here local in San Antonio. So when it comes to investments or retirement planning, having advisors, Firstmark has actually outsourced that to us, and we've been their provider for a while now. So you'll actually see me in some of the Firstmark locations, some of the branches here, financial centers, along with some other my teammates. So we're here for you guys to help serve in this community. So anything, again, that's going to be outside of banking, checking accounts, ATMs, debit cards, CDs, things like that, we're gonna step in and partner with all of the locations here in San Antonio for Firstmark. So a little bit about us, you can see, so we're actually headquartered in Austin. Again, I live here in San Antonio. We have $3.5 billion in AUM, our assets under management. We have 800 different districts that we work with here in the United States. Most of you are probably familiar with us on campus at your district already, because you're probably part of this RAMS region. For example, if you're an NISD or SAISD, East Central, a lot of the districts here are part of the co-op that's part of the RAMS region. And what that allows you to do is, being part of the co-op here local, is it gives you a lot of resources that you can split between the districts. And then these are some of the programs include here in the bottom, the 457, 403B, the FinPath. Some of these might be familiar to some of you guys. We're going to cover a little bit of that today. Some might not be. And again, as TCG, we are fiduciaries, which is a really big deal for us. What that means in layman's terms, that we have to act in the best interest of you, of the client. So we don't get compensated with commissions or sales charges, things like that, where predominantly a lot of people in the industry and finance or financial services get paid that way. That's not how we operate. So we are fiduciary, again, having a legal obligation to do what's in best interest of you. We only get paid on a fee-only basis. We're registered with the Securities Exchange Commission, the SEC. So we're really proud of a lot of that definitely makes us stand out from our competitors. So let's pivot a little bit here. That's just a little bit about us. So let's talk about you. Most everyone on the call today is going to be paying into the TRS system, right? Most of you have been for a while here in education. So if you look on the left versus the right, this is how most people save in the education space. A large part of that money that you're going to get in retirement is coming from TRS, right? Your pension here through the state of Texas. You might have some savings at the bank, a good portion. Some of you guys might qualify, especially in SAISD, you might qualify for Social Security and TRS, but a large percentage of what you're relying on is going to come through TRS, through Texas. Compare that to people that are maybe your neighbors or some of your family or friends. They don't have a pension system. So they're going to get Social Security sent to them every month, like you are from TRS, but majority of that money is going to come actually from them saving on their own in plans that are going to help build over time, because they're not relying on a pension like you guys. So that's one really, really good benefit of TRS. Lately, there's been a big push initiative lately on TRS's behalf to educate the educator. So there's a YouTube link here on the bottom of this link. That's gonna be accessed for you. It's free, doesn't cost anything. And it's gonna have small videos of different topics about TRS, you know, how to save, smart ways to do that, more about TRS and the plans and how they work and operate. So a lot of focus has been pushed on this. So I would recommend, you know, in your spare time, maybe over the holiday break, just check out some of these new videos from TRS. Okay, so this is a really good slide here. I know it looks a little busy at first, so let's focus on the top. This is the formula Texas is going to use to figure out how they're going to pay all of the educators and staff here in Texas in the education space. Okay, it's your total years of service, paying into TRS, right? Regardless of the district, regardless of your role, however many years you have paying in there, times 2.3% multiplied by either your 3 or your 5 highest years, and then they're going to average that number. Again, regardless. So if I'm in Northside and then I went to SAISD and then Judson, and, you know, you've been bouncing around a little bit, they're just going to look for your highest salaries in your whole career, regardless of your role, again, and regardless of your district. So if you take that formula here, we have an example. So someone's worked 30 years, right? So I'm an educator, I've worked 30 years. I take that times 2.3, that gives me 69%. And not my highest, but my average of those incomes is 60 grand. So you would see here down there in the bottom in bold, $41,400. That's the maximum I'm going to get from TRS per year. Another way to say that is, you can see here on the slide, is that I was used to earning 60 grand and I took a 31% drop in what I'm going to be getting paid at retirement when I retire. So it's a substantial drop. And again, that's with working 30 years, right? Which I would consider a good career, a healthy career. So it's things like this that we just have to be prepared about and plan for, which is kind of why you guys are here today. This is another popular topic about TRS. So it's the rule of 80. Again, I'm sure on your campus or in your district, you've heard a ton of different things. I'm the rule of 90, or I'm the rule of 70. So everyone is the rule of 80. The rule of 80 is a qualifier. It's not the percentage you get. That's just how you qualify. The formula is down here in the bottom. It's a very straightforward formula. I take my age plus, again, how many years total in all of Texas I've worked in TRS equals 80 points. So you add those numbers together, and once you get 80, then that's when you're eligible for most people to start getting money from Texas, from TRS, from your pension. Now, there are some caveats, and we'll get to that here a little bit later, but that's the basic formula for most people. Now, I know we're going a little quick on some of the stuff here, so I'll share my info at the end. Again, I'm happy on behalf of FirstMark to be a free resource for you guys. So if anyone wants to do appointments with me, one-on-ones, you know, we can actually calculate how much you should plan on getting when you retire, and then when you're going to meet your rule of 80, and just kind of get a little snapshot of what that's going to look like. So like I mentioned, there's some caveats with the rule of 80. Here they are. It's called tiers. So every October, November, y'all should be getting in the mail sent from TRS those hard copies, those letters, your earnings statement. Those are very, very crucial. A lot of good information is on that form. So when you get it, please don't put it in the junk drawer or just put it on a stack. I would encourage you to go through it. You're going to see on there, I believe it's the top left corner, and you're going to see what tier you are. That's important because that's going to show you when you're eligible, once you meet the rule of 80, to get those funds. As an example here, I'll just read the middle bar. So if I started after September 1, 2007, and had 5 years of service before 2014, my minimum age is 60 to retire and receive unreduced benefits. So again, I might reach the rule of 80 at 57 or 58, but since I fall in that tier, then I have to wait until the age of 60. Some people can get that money as soon as they qualify at the rule of 80, and some have to wait. At the bottom, you see the newer teachers, if anyone's on the call, newer to education, you started after 2014, you're going to be 62 is when you can get that money. This here is another good one. So again, for those that are looking down the line towards retirement, you're going to have several options when you retire of how you want your money paid out to you. Okay. The top left is standard annuity. This is going to be the maximum, the most you can get ever is if you choose this option. So just to put numbers to this, let's say I'm going to get $2,500 a month from Texas. That would be my standard annuity. These other options you can see 1, 2, 3, 4, 5. These are different ways you might want to get paid out depending on your situation. I would say option 1 is a good one to cover. So let's say I have my wife. So if I wanted to, what I can do through Texas is I can opt for option 1. And what it's going to do is now that payment is going to go not only to my life, but once I pass away, they're going to honor that payment and continue on to my beneficiary, to my spouse's life. So that way you're kind of guaranteeing income for 2 people, right? Rather than 1. Of course, there is a reduction for that. And you can see there typically between 8 and 13%. But a lot of people do like that, knowing they have the protection for their spouse that they are also going to get money that they can rely on for a while when you're gone. Again, there's other options here: joint survivor, option 3, option 4, option 5. This is really, really great for us in the planning process once you're a little bit closer to that big day. So if anyone on the call is looking to retire maybe here in 2021 or 2022, these are some decisions you're going to have to go through when you get your TRS packet. And I'm happy to walk through that with you guys and make sure you clearly understand what your options are. On this, once you select an option, you cannot change it. So if I select option 1 for me, and then my money's going to continue on to my spouse, I can never change it again. So if my spouse dies before me or something like this, you cannot change it. So again, that's why we want to just be a really good sounding board for you guys while moving forward. Okay, so now pivoting a little bit. So that's the TRS, which we all pay into automatically out of our checks, right? These are employer-sponsored plans that you have for your district. Again, I'm not sure what districts are on the call today, but if it's local ones here in San Antonio, East Central, Harlandale, Judson, Northeast, Northside, you guys are going to have some of these options here: a 403B, which most of you are probably familiar with, and then a 457. And outside of the district, you're going to have something called an IRA. So this is where we would really partner with Firstmark. Some of you might have IRAs at the bank currently, or have been interested in a traditional, a pre-tax IRA or a Roth IRA. These are just vehicles that you can use in addition to what your pension's going to be. So what is Roth? That's always a popular question, especially nowadays. Roth is just a way that you can treat the taxes that go into your retirement plan, right? So it doesn't have to be Roth IRA. I know that's what we hear all the time, but there's a lot of types of Roth. We can have a Roth 403B. We can have a Roth 457. What that means is that I'm going to pay taxes today on the money as I'm saving it into my retirement plan or to my account. So the benefit is that as that money grows, it grows tax-free. So when I take it out in 10 years from now, 20 years from now, I don't have to worry about the taxes, right? Because I've already was paying the taxes as I went. So a lot of people like this, I would say, because also what you see is what you get, right? So if I have $117,012, I know I own $117,012 compared to, let's say, as a pre-tax, if I have 117 grand in that account, that money's never been taxed before. So as I start taking distributions from that money, then it depends on my ordinary tax bracket at that time. So, it's harder to really know what you own in a pre-tax account, but there's pros and cons for both. Again, there's benefits for pre-tax, there's benefits for Roth, depends on a lot of things, y'all's income. Maybe is it just you as a single person, single earner? Is there a spouse involved? Are there deductions with kiddos, right? Things like this. So again, happy to walk through what makes the most sense for you, Roth or pre-tax. But again, we do have a lot of accounts through your district that you can also do Roth in. So this is a good comparison, a side-by-side chart here of a 403B versus a 457. Just in the spirit of time, I won't spend too much time on this. A 403B is what most of you guys are probably pretty aware of and educated on in your district. It's a retirement plan through your district. It's payroll deducted. It builds with interest rate. It compounds. And the goal is when you were older that we have that money to rely on. However, there is an age restriction at 59 and a half. That's really when we should be accessing this money, is 59 and a half years old. That's not a First Mark thing. That's or a district thing. That's an IRS. That's an Uncle Sam thing. So that's the magic number. Now, if we access our money prior to 59 and a half, because we left or we had certain events transpire, the IRS is going to charge a 10% penalty on that money. A lot of times, some of the companies that you're with, that you have your 403B with, will also charge you fees or charges, and then generally taxes come. So it's a lot if you're trying to access that money, because that's why it's earmarked, is to be long-term. A 457 is another type of plan that you could have where you're saving into it as well from your paycheck. It builds with interest rate, it compounds. I would say some of the main differences is that you don't have to be 59 and a half years old. So I could be 31, I could be 45, 52. And as soon as I separate from service, so working from the district, then you could get access to those funds. And the IRS is going to waive that 10% penalty. So there wouldn't be any penalty for you. So for some people, this might be a more flexible option. It has a little bit more of wiggle room, I would say. And a lot of times in the 457, they're going to be different investments that you can get traditionally than from your 403B. Again, I know it's a lot. it's after hours. So just know that you have two different options through your school, through your job, that you can save into: a 403B and a 457. So here, touching on the 403B a little bit, we already went through some of this here. It's payroll deducted. Again, you can do a pre-tax for most of these accounts and a Roth 403B. A lot of you guys are going to have a lot of different vendors through your school. And here they are. So if you stop and take a second here, some of you guys might recognize some of these companies. Some of these logos might be on the statements that you get, or maybe your company got bought out, right, by one of these other providers. So again, we're happy to do reviews for people. Sometimes, a lot of people have these accounts for years and they never really dig into them, right? It's just confusing. Maybe you don't understand it, or you don't have the time. Well, lean on us. That's what we're here for. We want to make sure that your money is doing what it should be doing. It should be growing and building in an account that's suitable based off your risk and is performing well. I always tell people there's two things we want really for all these accounts. We want a low cost, so low fees, and good performance, a high performance, right? So again, some of these are good companies, and I would say some of these are have some nuances that you should be really aware of. So the 457, again, this is your other retirement plan that you have. Generally, there's only going to be one provider, maybe two providers in your district. I can't say for always, but again, generally the 457 is going to be at a lower cost. So it's going to cost you a lot less per year to be in these programs than some of those 403B companies that we just saw. Again, a good option. This is something I also wanted to hint on here. This is called the IAC, the Investment Advisory Committee. And what this is all over here in San Antonio, all of a part of the Rams region, all different superintendents, CFOs, business personnel, and TCG, we all put our heads together, right? And what their goal is to look at is the investments and see, are some of these investments good? Let's keep those in there. Are some performing low? Are these some of the bad ones? Let's get them out. They generally meet a couple times a year and review these investments. I think the coolest thing about this is that Dr. Woods, I'll pick on him if there's any Northside people here. So in NISD, Dr. Woods, his money is invested with your money, or other superintendents of, SAISD or Harlandale, et cetera. So their money is in the same bucket as your money, which is really cool because it means you have a vested interest, right? They want those funds to be as high performing and doing as great as possible and at low cost, because that's where their money is. So it's not like their money is in a separate bucket because they're in a different, role or a different class. It's all together. And so I think that's a really, really great thing and powerful for you guys, knowing that they're giving a second layer of protection, watching all this for you. This is only in the 457. This is not in the 403B. So the 403B does not have the IAC. This is something that only happens in the 457. Now, when it comes to retiring, I know there's different schools of thoughts, of course, and on the stock market and things that happened in the past and future expectations. So what we've done is we've allowed you to have different profiles for your investments. You could be very, very conservative or all the way to an aggressive growth, as you see here. So the whole important thing is just really getting your attitude on risk and how much risk versus reward you're willing to take. I think what's great about a lot of these accounts is you can pick, let's say, a conservative account, and something transpires a couple of months later and you want to move your account to being more aggressive. There's no penalty or fee to do that. So you can slide up or down the ladder as you wish, which is really, really great. Again, no penalty or fee to do that. For some people, there's something called the target date fund. I call that the set it and forget it. So you can actually pick a year where you're projected to retire. So let's say for me, I'm going to retire in 2050 as an example. I can set my account for a 2050 fund. And what it's going to do is it's going to start on the aggressive side and slowly it's going to move all the way to the middle. And as 2050 becomes closer, it's going to creep and creep and creep more conservative over time, naturally, automatically. So I don't have to go in and manage it and update it, or every couple of years update it. No, it's going to do that by itself. So there's things like that. And I know some of you guys on the call, maybe you're really into this stuff, or your spouse is really into this stuff. So we also have where you can go online onto your portal, right? And you can go online and you can edit and change, however you want to be invested, 10% here, 10% there, 15% there. So a lot of options for you guys when it comes to your investment vehicle. Again, there's not just a one size fit all. There's just a really good amount of menu options for you. So there are some downfalls, some common pitfalls that happen with these retirement plans. Again, on campus, I'm sure you have coworkers or people in your pod or your department that have made some errors or some bumps along the way. So again, our goal is just to educate you to watch out for some of these things. And if you need another pair of eyes, that's what we're here for. These are just some common ones. Again, this isn't everything, but life insurance as an investment. A lot of times we do see life insurance sold as an investment, that it's kind of this combo 2-in-1. We're really from the school of thought that insurance is insurance and investment is investment, right? They should be separate. They have different means and purposes behind them. So that's one thing to watch out for. Pension maximization. Some of you guys might qualify to take some money out of TRS in the pension, the partial lump sum. A lot of companies are really, really pushing for people to do that. Based off the numbers that we've done in calculations, it doesn't seem to really make sense for most people. Again, there's different situations, but I would be a little weary if someone's really encouraging you to take that money out of Texas. And then also here, hidden fees. I think there's another slide here. Yeah. So again, the way that these things work best is when we can get fees go up and we can get our balances to rise, right? So we really want us to be careful for fees. A lot of times they are hidden. You have to look into your statement. Some companies are hopefully transparent with their fees and let you know about what you are signing or what annuity or product that you're getting and how that relates to cost. But some of these here, as you can see, again, I won't read all of them. One I will hint on here is the withdrawal charge. So we do see it pretty common in a lot of annuities that people have, that if you want to move your money from, let's say, A company to D company, that they're going to charge you a fee when you want to take that money out of your account and transfer it to a new company. Generally, these can be pretty steep. I've seen them as high as 9-10%, and they would take 9 or 10% from your balance. Or a lot of times what they do is it'll be decreasing. And so every year that you're with them, that fee will decrease by 1% or so. Again, even if you're there for 5 years with company A, and now enough is enough, and you want to leave the company D, they still, because you're under contract, would charge you a percentage of your balance to move your money. So again, just be upfront with people. If there's someone on your campus, someone presenting on your your PD day, or they're there during in-service or something, just ask them, look, I need to know what the fees are, and have them show you, right? Have them show you in writing or on paper what your fees are before you sign. This is just a great illustration here of fees. Again, I know I'm harping on this. It's just because we've seen this a lot with educators, and it's an issue. It really is, and we're trying to help people navigate through this. So let's say I'm saving money here. As you can see in the bar graph, I'm saving $200 a month, and I've been doing this for 20 years, right? So for a long time, I'm saving money. Everything on the right over here on this chart, this 1% fee, if I was getting charged a 1% fee every year, at the end of retirement, my account would be 82 grand, okay? But let's say I had company and they were charging me 3% as my annual fee. You can see that balance drops, right, to 82 to 65. And that money didn't go into my pocket, right, or our pocket, it went into the company's pocket. And so as you can see, when fees go up, our balance goes down. So we really just want to be conscious that we're paying just as little as we can, but still getting, good performance, good bang for our buck. So keep moving here. Social Security. So switching topics a little bit. Again, some people here today, y'all have been paying the Social Security. So you might have some questions on this. Some districts, SAISD is predominantly the main one local that pays into both, as I'm sure y'all know. If I'm getting money from Texas, from TRS, it's never going to be reduced by Social Security, period. Regardless if I'm getting $100 a month from Social Security or 2,000, whatever I'm promised from Texas that they're going to give to me every month, I'm going to get that money. So there's a lot of rumors out there, a lot of misconceptions about, oh, I can't get both, or you get one or the other. No, you can get both, and your TRS, again, is not going to be impacted by Social Security. Now, here are some considerations. Again, happy to go more detail today. We'll keep it lighter. One is called the GPO, the Government Pension Offset. Now, this applies to my benefit from my spouse. So a lot of people have a spouse that works or worked in the private sector, and they want to get a portion of that benefit from them, maybe even an ex-spouse. So here you would see a reduction on your benefit. And then there's something called the WEP, the Windfall Elimination Provision. Now, this is about my own Social Security. So if I have paid into the Social Security system and to the TRS system. So again, don't want to get in the weeds on it today, but there are some things to look out for, but just know that it is possible to get both. And that's something that we can help you kind of walk through and calculate. So nearing the end here, I would say here's some couple of quick action items that we can do to make sure that we're on track for retirement or just for planning in general. One would be write down your goals. I know it sounds cheesy and sounds easy, but it's a great thing to do to visualize those goals and actually put them on pen and paper. What does retirement look like for you? Some of us want to go to Corpus and just fish, and we're good with that. Some people want to go to Spain. Those are drastic different dreams. Some people want to travel. Some people want to own a hobby, or a lot of people don't want to stop working. They want to do something else, not in education maybe, but they still want to work. So just knowing that and then getting the cost associated with that really helps figure out, hey, are we going to be okay? Right? Are we going to have enough money coming in that I'm going to be able to live and have the retirement that I want? These next two are really great websites. So if you guys want to take a photo of that or write those down, one's the MyTRS. So again, that piece of paper that you get every October, November timeframe, if you haven't gotten it or you didn't get it for some reason, you can create a profile there online, and that'll have everything there for you when it comes to TRS, right, through Texas. That'll show you how many years of service you have, your salaries, your highest average. That's just a great resource for you. And then SSA.gov, that's the Social Security website. A lot of good information over there. Probably too much information. There's information overload, but a lot of good stuff there to look again, and that can help also to explain the offsets and things like that if that's going to impact you. Cash flow, getting a budget. We strongly encourage people to save into these retirement accounts. Obviously, TRS is automatic, right? So we're all doing that. You can't stop saving into TRS. You can't increase that, decrease that. You don't have any control. I like to tell people over that. But these supplemental plans through your districts, through your jobs, you do have control over that. Again, you can pick which plan makes the most sense for you. We can pick pre-tax or Roth. You can change your dollar amount. You can increase it, decrease it at any time. So a lot of flexibility in those plans. And those obviously over time are going to help us reach our goals, right? This is something here I'll probably close on. So this is a wellness program that we have for people that really just want to get the basics of Finance 101. Maybe you understand some stuff today, but some stuff you still have questions on. This is a great tool that has courses online. There's calculators on there where you can go and learn about just everyday common financial questions, financial scenarios. As an example, FICO scores, right? Credit scores. How do they work? How do I build credit? How would I lose some credit? Refinancing my car, does it make more sense to pay this versus that? Budgeting, right? All of these kind of finance, 101, just really good ways to start building your knowledge up. Some of us have a background in this, like I said, maybe your parents taught you, your grandparents taught you, you got a really savvy brother or sister. Some people we don't, right? No one has ever taught us this kind of stuff. This is all new to us. So regardless of where you are on your learning curve or in life, this is a really great tool that you can use that we can help you get access to. So I'll just close here, Doug. This is my information. Again, my name is Dominic. I live here. I work here in San Antonio. I'm a part of TCG. Again, you'll see me in a lot of these First Mark Credit Union, financial centers all across, here on 281, 1604, and Huebner. So I'm there pretty often. But I'm here for you guys. We're educator focused. Again, TCG is in a lot of your districts. I'm sure you've seen us or familiar with us in some capacity. But we're a resource for y'all. So just use me. Again, especially next week, you guys are off, most of you, for the holiday. So when you're working, I'm not working. Or sorry, when you're not working, I am working. So it's a great time of the year where you got some downtime. It's slow. You don't have kiddos in the classroom. So just hit that QR code. Again, it goes right to my calendar. We can block off 30 minutes. We can block off an hour. Virtual meetings if you want your spouse to be involved, maybe just even a quick phone call, right? So happy to do all that for you. As long as we're just getting a plan in place, thinking of the future, that's what's important for us. So with that, Doug, I think I'll turn it over to you.
Great. Well, thank you, Dominic. That was great information and you did a great job. There's not tons of questions, but we have a couple of really good ones. So we want to give some time for question and answers. Not too late. If you still have some questions, feel free to put it in the Q&A below. The first one that is a very common question is, what if I already have a 403B with my district? Can I switch it to a 457B?
That's a great question. So unfortunately, if I already have a 403B in my current district that I'm in, you cannot switch it to a 457. Now, if I have outside, so right, let's say I'm in Northside, I'm in NISD, but I was in Judson and I have money still in Judson, I can move that 403B into my 457 here. But if it's already in your current district, yeah, the district doesn't like us going back and forth between both plans. I'm just going to add one thing on that, Doug. It is possible to have both plans, just so you know. So you could have a 457 and a 403B, and you could save into both potentially if you wanted.
Right. And just a side note, you can also switch from vendors. So if you're with one 403B vendor, you want to exchange it to a different vendor, that is allowable. It's just not the merging of the two accounts. Okay, very good. Another great question came through. Why would the 403B or 457B be preferable to an IRA? Neither, it doesn't matter if it's Roth or not. And does the employer pay into it at all?
Yeah, that's a question we get a lot. Gosh, I wouldn't say it's preferable. It just depends on your situation. So some quick facts come to mind. So one would be your contribution amount. Okay. I don't know if anyone on the call knows, I guess, trivia question. What is the maximum that I can put into an IRA per year? Let's say I'm 42 years old. What's the max? See if there's any people out there. If you want to put in the chat, what's the max I can save in an IRA, Roth or pre-tax? The max if I'm 42. 9 grand. It's a good guess. Pretty close. 5K. Good job. 15K. Let's see. Wait for one more. Let's see. You guys are close. No one's got it quite yet. $6 grand. I'll go with the answer. So 6,000. So 6,000 is the max that I can put total, right, per year in an IRA, Roth or pre-tax. Second trivia little question. What is the maximum I can put? Again, I'm 42. What's the max I can put into a 403B through my job or a 457 through my job? How much per year could I do on that? Let's see y'all's guesses. 16,000. Okay, close. Patricia, Karen, Kelly, any other guesses? 19.5. That's correct. Hopefully you didn't Google that, Kelly. But yes, yeah, 19.5. So back to that question, Doug, one major difference is the contribution amount. In an IRA, it's only 6 grand. In a 403B or a 457, it's 19,500, right? That's a big bucket. So I would say 1, 2, it's payroll deducted. So it's kind of like this, right? Just out of sight, out of mind. Very easy for most people just to do it through your payroll and get it deducted that way rather than through your bank and having to automatically draft that money. I see Kelly's comment here, so I'll just answer that one. So the max in IRA at age 50 and over, you're allowed to do a catch-up contribution. So the IRS lets people that are 50 or older actually put more to help them catch up into saving. And you can do an additional, excuse me, that was for an IRA, an additional $1,000 in an IRA. Yeah. But as far as IRA, they're just different. You're going to have a lot of investment options in an IRA. They're both going to help you reach your goals. I think just through your employer, sometimes it's a bit easier. You've got more also loans available to you. So if you had hardships or disabilities, first-time home buyers, there's provisions in these retirement plans through your job that allow you to take that money out and to get a loan on it. In an IRA, there is no provision that I'm aware of, Doug. You can correct me, but I don't think there is any provisions in an IRA that allow you to take loans out or things like that.
No, that's exactly right. So some people will actually roll their IRA, traditional IRA. You can't roll a Roth IRA, but a traditional IRA into their work plan so that they do have access to borrow it. So that's good. Now, I'm sorry if I missed what you said, but they also asked if the employer pays into either plan at all, and most employers don't, right? But that's not, the main thing is just that you're paying into or saving your own money for retirement. On that same subject, real quick, we got a question like, what is the maximum into both? So that would be a question that you could answer about for the 457?
So a 403B and a 457, again, the maximum is 19,500. And in an IRA, the max is 6,000. If I'm above the age of 50, they're different numbers. They're higher because you're allowed to kind of, like I said, catch up. But for anyone on the call under 50, the max is 19,500 per year in a 403B and a 457, and then an IRA is $6,000. And these are all IRS limits, right? Nothing to do with Northside or SAISD, Judson. These are all from the government.
And just to be clear, like, we're not tax advisors. I'm sorry, the question was, can you do all three, basically? And the answer, short, yes, but you may have some tax questions you might need to run by a tax professional regarding a traditional IRA if you're also doing a traditional 403B and traditional 457, because there is some, tax deduction stuff, and it may not qualify if you're doing both, but that's something to check with a tax advisor about. Okay, before we close out, there's another great question about someone who's moved, I guess, from California. So they have both TRS and CalSTRS, which is the California pension. And should they try to combine them or keep them separate?
Yeah, that's a great question. Ironically, we've gotten that a lot lately. Obviously, a lot of people moving from out of state here to Texas. I would say the fast answer is that's probably best for discussion one-on-one. It depends how many years of service you have in California. You can purchase service credit. So here in Texas, they allow you to use military credit or out-of-state service, and you could add that to your years here in Texas, which is going to help increase that benefit, right, that we get per year. So, being a military town, USA, we see a lot of military people try and use some of that if they're now in education to add to that, or out of state. So, sorry, I know it's not a great answer, but that would be my fast answers. It just depends, how many years you have there, how many do you have here. It is going to cost money, right, to do that. So that's something that we could kind of probably best on a one-on-one basis.
Yeah, that's great. Yeah, and just remember, there are some reasons that you can buy service credit. Again, if you active duty military, if you were a substitute more than 90 days in the school year within the past 5 years, career technology certified teacher, just some of those different reasons why you can add to your credit. Of course, working in out of state service can count too. So any of those things, definitely contact us or make an appointment with Dominic and go over those individual type questions with him. Well, this has been great, Dominic. Thank you for all that information. I don't see any other questions at this time. So unless
I just wanted to pose one for the group. I won't make this a group chat question, but I don't know as of today's date, but I know a couple of weeks or so when I was looking, the interest rate that they have right now at Firstmark for their IRAs was 0.05, which is way less, right, than 1%. So I would just say, if anyone does have any IRAs at the bank, whether that's RBFCU, SSFCU, here in Firstmark, we're happy to review those for you, because again, the name of the game is just getting that money to work as hard as we are. A lot of us are working very hard in education, obviously, and some of us have side hustles or part-time jobs on the side, but yet our money is in the bank in cash in these IRAs, just sitting there, and it's earning, little to nothing. As you guys know, rates on CDs and checking account savings accounts are really at an all-time low. So just something to be aware of. Again, I'm there in the branch most days, or here in, on your campuses. But if you have those too, feel free to come with us and for reviews or updates on that kind of information to make sure that your money is doing what it should be doing. So. I think something popped up in the Q&A. Okay. Cool. Well, Patricia, Kelly, Karen, everyone that participated and is on the call today, thanks so much, guys. Again, there's my information. I'm happy to resource a phone call or meeting. And I wish everyone a safe and happy Thanksgiving with their family and friends. And we'll talk to everyone soon.
Thank you, everyone. Have a good evening.
Bye-bye.